Hello from Hong Kong. I'm Aidan Gregory, Senior Correspondent at InsuranceAsia News. We're in Quarry Bay this afternoon and I'm joined by Tony Gallagher, CEO of Asia Pacific at Guy Carpenter. Thanks for joining us this afternoon, Tony.
Pleasure to be here.
We're almost halfway through the year, so it's a great opportunity to be discussing the outlook for the reinsurance market in Asia Pacific. Perhaps a good place to start maybe would be how's the reinsurance market in Asia Pacific shaping up?
I think that the market has transformed quite significantly really through 25 and into 26, and you talk about the first quarter and the second quarter. I think there's differences within the first quarter and second quarter. A couple of points that I would note. One is the changing nature of risk. The business that we were writing in 2025 is changing very quickly, and technology is driving a lot of that change. So we're seeing a lot of risk around semiconductor technology, a lot of risk around data storage. We're seeing a lot of risk around supply chain risks and things like that. So the nature of risk is changing within the marketplace, which means the nature of exposure being transferred to reinsurance companies is changing too. I also see that on the natural peril side of things, that the frequency of events continues to increase and the severity continues to reduce. And that's been a trend really over the last 2 or 3 years. So looking at the first quarter and the second quarter, we've seen that the reinsurance industries continued to really elevate itself away from frequency losses. And in other words, they've increased their retention. And we've seen that increase effectively mean that the insurance companies now retain that volatility. So the volatility that probably 3-4 years ago was being transferred to reinsurance companies is now being retained by insurance companies. So with this volatility, we saw a market where we had supply outstripping demand. So the reinsurance capacity was more abundant than what the insurance industry really needed. And that was a function of the structures retained relatively stable, the terms and conditions were relatively stable. And so the thing that changed in the first quarter were rates reduced by probably around about double digit, most lines of business, proportional and non-proportional. In the second quarter, that rate of increase probably increased slightly, but still maintained through into the second quarter. So you're really having a market now which has got increased volatility. The insurance companies will be very happy with the savings that they would have made on their placements in the first half of this year. But what's happened is this volatility has been retained inside these insurance companies. So there's been a real shift, really, which started 24 months ago, and the outcome of that today is still the same. When that moves into this changing nature of risk, this increased volatility as an industry, I look at that in terms of making sure that the insurance companies understand there's increased volatility within their portfolio, which is different to what it was 12 to 18 to 24 months ago. So the savings that you have from your reinsurance, well, is that enough to offset for the retained volatility within the portfolios?
We are in quite a clear market softening. Do you see that sort of continuing throughout the rest of this year and through 1/7?
It's going to depend on a number of factors within the market through that. You talked earlier about geopolitical risk, the overall landscape, the loss activity. These are all factors which are going to be very important in relation to what happens in relation to the pricing and the terms and conditions and the coverage within the business. All things being equal, the rate reductions or the pressure on rates will continue through there. And that's assuming there's no more significant losses and the portfolios continue to perform as they are. But there's a lot of things that are going to happen over the next 6 months. And that period will give us a window in terms of 1/1/27. The market has excess capacity, so the capital is still there. The demand is still relatively stable, so you would still see supply outstripping demand in the current market. But I think things could change over the next 6 months.
How have you observed the state of pricing and capacity in the region? Do you see quite strong divergences between different territories, like India, for example, versus Australia?
I think each market has its own cycle, and the cycle was a little bit dependent upon the market results and the competition within that marketplace. And so overall, we're seeing double-digit reductions across Asia Pacific. Those reductions could be slightly higher on a particular portfolio, a particular client, or a particular country. So not all things have moved equally. So when the market hardened and the rates went up, we saw that disproportionately in some markets versus others, because some markets had a heavier risk or cat loss versus other ones. So similarly in this market, be it India or be it China, Korea or Japan, the rates have moved at a slightly different factor. But the overall trend is the same. It's just the acceleration or deceleration of those. But overall, the umbrella of excess capital is bringing really the whole market this year. We saw reductions across the board, no matter which market you were really in.
Yeah, I mean, when you read some of the recent renewal reports, there's very steep double-digit reductions across most major lines of business.
That's right. It's double-digit reductions across almost all markets, I would think. And in Asia, of course, property and casualty are the big classes of business which drive a lot of the volume. The results have been good for the reinsurers. There's been low cat events, reinsurance cat events. So you would expect this trend to change. And the other thing that's occurred is there's been structural change within the market where the reinsurers have raised their attachment points. So once again, there is a benefit to having a raised attachment point in terms of more competitive reinsurance pricing.
The first half of this year has very much been characterised by geopolitics, and I'm sure many of your clients obviously welcome the peace deal announced between the US and Iran last week. Having said that, a lot of the disruptions from the conflicts are likely to stick around for quite a while. If you think about all the ships that are still stuck in the Strait of Hormuz and the impact on energy prices. Now, how have your clients been weathering the crisis? So what would you say have been the major impacts on the reinsurance market in our region?
There's been a lot of geopolitics in the last 5 years. If I look at it, we've had the Ukraine war as well. So when I look at the current crisis, it's on the back of other geopolitical changes which have occurred internationally, but also within Asia as well. The current situation there, I see as direct and indirect impacts. So the direct impacts, a lot of our clients are looking at their direct exposures that they have within the conflict, so ships particularly, within the zone, the losses that may have occurred within those vessels, or the losses that are likely to occur within those vessels, and making sure that they have significant capital and understand the overall exposure for those vessels or cargo, whatever it may be. In terms of the indirect costs, that will play out. So this could be something like inflation or supply chain disruptions. So how that plays out, I think, is probably going to be more significant than the direct impacts. So the direct impacts relatively ring-fenced around the zone with a certain number of vessels which we can quantify and understand. It's the indirect which I think which will impact the industry more, and the longer these situations go on, the longer the impact could be. Inflation, supply chain could be something that comes through later 26 into 27, and that's something that I think would have a bigger impact than the current direct today. The other impact then would be really around the future, and the future impacts could be things like terrorism or cybercrime. Could there be some other longer term impacts which affect Asia, which is not affecting Asia today? So the industry here is pretty robust. The geopolitical landscape that we're in, I think that the industry is well protected and well capitalized to be able to understand and support the direct costs. And I think the indirect cost is something that we'll have to look at, because these could have longer lasting impacts along the bottom line profitability of both the insurance and the reinsurance industry.
The other big emerging story at the moment, given that we're also at the start of typhoon season here in Asia, is the arrival of El Nino, and many are even talking about a Godzilla El Nino this year. How do you expect that to shape the reinsurance landscape in Asia?
Yeah, when I look at El Nino, I often think that Northern Asia is wet and windy, and Southern Asia or Australia is dry and hot. And so you've sort of got the two different impacts affecting the industry in different ways. If you have an increased frequency of mid to small floods, this will be retained with insurance companies. And it's something insurance companies should look at in terms of the weather pattern and the impact it could have on its retained losses. When you have typhoons, you need larger events now before the reinsurance industry has impact. So the reinsurance industry really is starting to become a tail or large event protector, but not so much in terms of mid to small events. So what that means to me is that the mid to small events, the insurance companies need to think about non-structured or other solutions to provide capital and earnings protection for those in an El Nino period of time, be it hot or dry, depending on where you are. In the second quarter of this year, we saw an increased interest in the number of structured products, which is good for the insurance company's balance sheet. The Guy Carpenter prediction is, of course, for typhoons is a higher season in Northern Asia. And that's something that should be a warning for the industry to prepare for such events. And you prepare for that by making sure that your retained amounts are protected sufficiently and adequately through right covers. And that's what I see the industry really doing over the next 6 months. But also it occurred quite a lot in the second quarter this year.
The industry's been quite lucky over the course of the last couple of years, but we have seen increasing frequency and severity of secondary perils already. You expect that to continue throughout the course of this year into next year?
Yeah, secondary perils or non-modelled perils really have become an insurance event, not a reinsurance event. With the increased retentions on many CAT programs, a lot of the unmodelled flood would be retained within the insurance company's balance sheets. The frequency, I think, will continue, and particularly in an El Nino year, maybe the severity could increase. This would be a change. So I think the frequency we've seen the last couple of years, a pretty stable increasing frequency of floods, but the severity hasn't occurred, which has led to this benign period of large CAT events within Asia. El Nino year could change that, and that's something that when you plan your reinsurance, that's what you should be looking at.
In Asia, it's offset somewhat by the fact that the region still has a very large protection gap, particularly in the emerging economies.
We do. That protection gap continues to exist. Insurance penetration is increasing, but still pretty slow. And I think that for the protection gap, products such as parametric and ILS are products that could be very helpful to provide quick sources of payments in the event of losses in areas where there's underinsurance. And I think the parametric product is something which is going to expand also throughout the course of the next few years.
That brings us nicely into the next question, which is, are you pleased with the progress that's been made in terms of the development of a local ILS market and ecosystem here in Hong Kong and in Singapore as well?
Both Hong Kong and Singapore have done a tremendous job of promoting ILS solutions within Asia and also attracting solutions from around the world. I see that will continue, and I know there'll be 2 or 3 more transactions this year, which is great news for both Hong Kong and Singapore, which have established themselves as leaders and as comparable markets for ILS transactions. I think the expertise is now evident within both countries, and I think that there'll be more transactions. It really connects to me in terms of is parametric in providing insurance and filling that protection gap. And so it's really encouraging that within Asia, we're able to have two hubs to provide ILS solutions and non-structured solutions throughout Asia.
Do you see greater demand from investors too for new and diversifying perils from the region?
There's a lot of capital. Globally, Guy Carpenter has seen an increase in cat bonds and ILS solutions around the world. In Asia, it's still relatively slow. I think with the traditional market, with the lower price of cat in the traditional market, it's meant that the uptake of ILS has been slower. But in terms of long-term structuring, I think it's good to have new capital and old capital alongside supporting companies in the event of a natural peril event. And so I think Asia's been a bit slower than, say, other parts of the world, but I think it will increase.
Given that we're at the end of the first half, it does look very much like the record for annual cat bond issuance will get broken again globally this year.
That's right, and that is no surprise to me. I think the demand for cat will continue to increase. If I looked at 27, 28, Asia's demand will continue to grow from a small base, but I think that will also happen as well.
Hong Kong has basically created an ILS regime from scratch in the last 4 years, and the progress that's been made so far is admired by many. What would you like to see next in terms of the next phase of the market's development in the region?
I think for the region, MGAs are very important, and the IA has been very supportive of the MGA business and the industry in Hong Kong. MGAs, to me, are a business which is different to what it was 5 or 10 years ago. It's really insurance-light businesses using technology and distribution and manufacturing with third-party capital. And so I think that the MGA landscape has changed quite dramatically. I think it's something that is here to stay, and I think many MGAs would, with the help of technology, really become future insurance companies. And I'd like to see the IA continue to build support for the MGA network and the MGA businesses throughout Asia. And I'd like to see that in other Asian centres as well. So that's one area I think is quite important. The other area I think sort of linked a little bit to the ILS is around structured and capital solutions. It's trying to bring third-party capital in to the insurance industry to provide solutions for clients and markets. And so I think that could be in the form of structured solutions. It could be in the form of getting new capital, Asian capital, to start to invest in the ILS transactions. And that's something which I think is yet to occur. And I think the associations around Asia could be really supportive in trying to build that out.
There's certainly no shortage of capital here in Hong Kong, but the current problem seems to be that it just doesn't invest in ILS, which seems like that's something that needs to be encouraged to change. I
think so, and I think the IA's got a hand to play in that. And I know they're supportive of the ILS industry generally, and I think this is an area they could continue to support to build that capital out. It's interesting because other markets and other territories, there's certainly an interest, a huge interest in supporting ILS industry around the world.
There's talk soon of Hong Kong introducing a framework for the structuring of sidecars locally, and that's something which, based on the conversations that we've had with people in the industry, that there is real kind of genuine enthusiasm to see that happen, and people see massive potential for it.
It's a natural extension to the ILS, I think, and sidecars is certainly an area which is growing in level of interest throughout the world, and we will see sidecars being issued all around the world, including Hong Kong, I believe, in the next couple of years.
Thanks once again for joining me this afternoon, Tony. It's been great to listen to your answers. I'm sure the second half of the year is likely to be just as eventful as the first half was.
I think so. I think it'll be a year of interest, and I'm at the SRIC. I look forward to sort of catching up again by then we'll have a closer view on what 1/1 will be looking like. Thank you.
All right. Great stuff. Thank you.
Thanks.